The world's wealth is shifting before our eyes, yet most people remain unaware of the scale and speed of the change. Economic history shows that moments like this precede enormous financial upheaval and concentrated transfers of wealth. Governments are borrowing at unprecedented levels while central banks expand credit like never before. Every dollar printed today carries hidden consequences that will ripple through generations. Inflation is rising quietly, eroding purchasing power, while asset prices soar to artificial highs. The same patterns have triggered financial crises countless times throughout history. Between 1921 and 1923, Germany's Weimar Republic experienced hyperinflation, where the currency lost 99.9% of its value within months. Families watched their life savings evaporate, showing how debt and monetary mismanagement can destroy wealth overnight. The paradox of wealth today is striking. Stock markets climb, yet real wages stagnate and debt grows. This contradiction mirrors the exact preconditions that historically led to systemic collapses. Global debt now exceeds $300 trillion, more than 3 times world GDP. Sovereign borrowing, once a controlled tool, has become an accelerating engine of financial instability. Central banks purchase government bonds aggressively, effectively monetizing debt to keep interest rates low. This intervention stabilizes markets superficially, but masks an underlying fragility in the system. Currency dominance is shifting subtly, with the US dollar remaining the primary reserve but facing emerging challenges. History proves that reserve currency transitions often trigger global wealth redistribution and market volatility. In 1997, the Asian financial crisis began with currency devaluations in Thailand, rapidly spreading across Southeast Asia. Countries with high foreign debt and inadequate monetary controls suffered catastrophic wealth destruction. Investors today are unknowingly positioned in the same structural conditions that sparked these crises. Over-leveraging, paired with policy missteps, sets the stage for a similar magnitude of wealth transfer globally. Historically, economic collapses follow a predictable chain: excessive debt, aggressive credit expansion, inflationary pressure, and currency stress. Once triggered, these elements interact in a feedback loop, amplifying financial instability. Banks create credit far faster than actual capital, inflating asset prices while liabilities accumulate quietly on balance sheets. This system benefits early entrants and insiders, but leaves latecomers exposed when the cycle reverses. Monetary policy often lags behind reality, responding to crises after they occur. Central banks then implement emergency measures that mitigate panic but further distort market signals. Inflation erodes savings gradually, transferring purchasing power from the general population to asset holders. Those positioned in tangible assets, equities, or commodities historically gain disproportionately. Sovereign debt crises follow a pattern of unsustainable borrowing, rising interest obligations, and eventual default or restructuring. The timeline varies, but the underlying mechanisms repeat with remarkable consistency. In the 1980s, Latin America faced a debt crisis where countries like Mexico owed more than 100% of their GDP. High interest rates on borrowed dollars forced austerity, social unrest, and massive private sector losses. The banking system amplifies these effects because leverage concentrates risk across institutions. When losses materialize, central banks intervene, creating winners and losers in the process. Credit expansion and asset bubbles often occur in parallel, creating the illusion of prosperity. This illusion tempts governments to borrow more, perpetuating the cycle. Wealth transfer is a natural byproduct of this cycle, as early holders of real assets accumulate wealth at the expense of those exposed to inflation or debt defaults. History demonstrates that these transfers are rarely subtle or gradual. Understanding these patterns allows observers to anticipate systemic risk and identify opportunities. Ignoring them leads to the same losses witnessed in prior crises. The 2008 global financial crisis originated in the U.S. housing market, where mortgage-backed securities masked the true scale of risk. Banks leveraged these assets excessively, creating an intertwined web of exposure. Lehman Brothers collapsed in September 2008, triggering a cascade of liquidity shortages across global banks. The Federal Reserve injected trillions in emergency funds to stabilize the financial system, illustrating systemic vulnerability. Sovereign debt followed quickly as governments bailed out banks, increasing national debt burdens. For example, U.S. debt jumped from $9.6 trillion in 2008 to over $11 trillion by 2010. Greece experienced a debt crisis beginning in 2009 due to structural deficits and Eurozone rules. Unemployment surged, pensions collapsed, and wealth was effectively transferred from citizens to creditors and international institutions. The 1994 Mexican peso crisis provides another precedent. Overleveraging and political missteps led to a rapid devaluation of the peso. Investors in U.S. treasuries and foreign capital benefited, illustrating early mover advantages. Japan's lost decade in the 1990s followed an asset bubble in real estate and equities. Despite zero interest rates and monetary stimulus, The economy stagnated for decades, highlighting long-term consequences of financial mismanagement. Historical cases consistently reveal that public debt, monetary policy errors, and banking leverage converge before wealth transfers occur. Early identification of these conditions can determine who gains and who loses in such cycles. The U.S. savings and loan crisis of the 1980s shows how deregulation and poor risk assessment can destabilize banking institutions. Billions in taxpayer funds were used to stabilize failed banks, redistributing wealth indirectly. During the 1929 stock market crash, margin trading created massive leverage in equity markets. When prices fell, ordinary investors lost life savings while insiders positioned in cash or gold survived and prospered. These examples demonstrate a recurring theme. Those with liquidity, foresight, and asset exposure benefit while debt-laden or illiquid participants suffer. The pattern is universal and repeatable across decades and continents. Today, U.S. national debt exceeds $33 trillion, an unprecedented level relative to GDP. Interest obligations alone consume hundreds of billions annually, constraining fiscal flexibility. The Federal Reserve maintains interest rates near historic lows, even amid rising inflation. This policy encourages borrowing but hides underlying debt accumulation risks. Global quantitative easing programs exceed $20 trillion in combined central bank balance sheets. Asset prices inflate artificially, creating wealth concentration among early investors. Emerging markets carry over $10 trillion in dollar-denominated debt, exposing them to currency depreciation risks. Capital flight and devaluation could trigger rapid wealth erosion for ordinary citizens. Corporate debt has surged alongside sovereign debt, reaching record highs of $12 trillion in U.S. non-financial corporate borrowing. Leverage ratios resemble pre-2008 levels, signaling potential instability. Cryptocurrency markets have attracted speculative investment, offering alternative stores of value. Yet volatility remains extreme, demonstrating the risk of sudden wealth shifts in unregulated systems. Inflation rates globally have reached multi-decade highs in some regions, eroding real income for workers. Meanwhile, equities and real estate markets continue to climb, benefiting asset holders. Reserve currency dynamics are subtly changing as China and other emerging economies increase global trade in yuan. Historical patterns suggest such transitions create periods of financial rebalancing and wealth redistribution. The combination of high debt, low interest rates, and aggressive credit expansion mirrors conditions in prior crises. Observers argue that this alignment signals a potential historic wealth transfer on the horizon. Understanding the modern system requires recognizing who holds liquid assets and who remains exposed to inflationary erosion. This distinction defines winners and losers before the crisis unfolds. If debt accumulation continues unchecked, governments may face difficult decisions: inflation, austerity, or currency devaluation. Each option redistributes wealth in predictable ways. Bondholders may face losses if interest rates rise rapidly, while equity and real estate holders could retain relative gains. This scenario resembles past episodes of systemic wealth transfer. Inflation acts as a hidden tax, eroding the value of savings held in cash or fixed income. Those with early exposure to real assets effectively profit at the expense of late participants. Sovereign debt restructuring, as seen in Argentina in 2001, could force creditors to accept steep losses. Public and private investors must remain aware that government borrowing is not risk-free. Banking crises are likely if leverage is mismanaged or asset bubbles burst. History shows that central bank interventions can stabilize systems temporarily but rarely prevent wealth reallocation entirely. Commodity prices may surge as currencies lose purchasing power, benefiting holders of tangible goods. Speculative activity often accelerates wealth transfer during these periods. Real estate may experience a dual effect: short-term volatility and long-term concentration of ownership. Those positioned with liquidity and capital often acquire properties at discounted prices during downturns. Technological disruptions and fintech innovations create new avenues for wealth concentration. Digital platforms centralize financial flows, often benefiting early adopters or insiders. Demographics also play a role. Younger generations may carry debt burdens, while older generations retain assets. This intergenerational transfer mirrors historical patterns of wealth reallocation. Understanding these implications is critical for both policymakers and investors. Timing, positioning, and awareness define who gains and who loses in historic wealth transfers. Debt monetization by central banks artificially suppresses borrowing costs, inflating asset prices disproportionately. Investors in equities, real estate, and commodities effectively capture wealth generated by monetary expansion. Fiscal deficits, financed by bond issuance, concentrate risk in sovereign obligations. Those holding sovereign debt at favorable rates benefit initially, while taxpayers absorb long-term costs. Banking leverage amplifies shocks, creating a rapid redistribution mechanism once instability emerges. History repeatedly shows that these redistributions favor capital-rich actors over the general population. Credit expansion inflates speculative bubbles, masking the underlying fragility of the system. When bubbles burst, wealth shifts dramatically to those with liquidity and foresight. Policy interventions often appear stabilizing, but introduce moral hazard, encouraging further risk-taking. This perpetuates cycles of asset inflation followed by wealth redistribution during correction. Wealth transfer accelerates during periods of systemic stress, not gradual economic shifts. Crises act as catalysts that make hidden transfers visible in asset valuations and purchasing power changes. Currency devaluation systematically shifts wealth internationally, benefiting exporters and commodity holders. Those holding domestic cash or fixed income assets experience losses in real terms. Sovereign debt restructuring, implicit or explicit, further reallocates wealth from public to private sectors or from taxpayers to institutional creditors. Past examples demonstrate this outcome repeatedly across decades. Institutional investors, hedge funds, and private equity capture outsized gains during these transfers. Their early positioning ensures disproportionate benefits relative to late market entrants. Recognizing these mechanisms is crucial for navigating future wealth transfers intelligently. Awareness and strategic positioning define the difference between loss and gain in systemic cycles. The biggest wealth transfer in history is not speculative. It is a documented outcome of predictable economic forces. Those who understand debt cycles, credit expansion, and monetary policy stand to benefit. Public perception often overlooks these structural shifts, focusing instead on short-term market news. Historical precedent suggests this inattention amplifies the effects of wealth redistribution. Central banks and governments operate within constrained tools that inevitably influence asset allocation. Early actors with foresight consistently capture disproportionate gains in these cycles. Investors positioned in tangible assets, equities, and commodities historically gain during periods of systemic stress. Meanwhile, cash holders and over-leveraged borrowers face erosion of wealth and purchasing power. Awareness of global debt levels, reserve currency dynamics, and credit cycles provides a predictive edge. Knowledge of these patterns allows participants to anticipate and respond to systemic transfers. Intergenerational shifts are also a factor, with younger generations often inheriting debt burdens, while older generations retain assets. Historical parallels reveal how wealth naturally concentrates in such environments. Timing, liquidity, and asset exposure remain critical determinants of success or failure. Those who recognize early signals must consistently position to benefit from wealth redistribution. Historical crises, from Weimar Germany to the 2008 global financial crisis, underscore the predictable mechanisms of wealth transfer. Patterns repeat, and opportunity favors those who observe rather than react. The ongoing convergence of debt, monetary expansion, and credit leverage signals a historic redistribution of wealth is underway. Understanding these forces is not optional for anyone seeking financial resilience. The biggest wealth transfer in history is no longer hypothetical. It is happening now, quietly, methodically, and inevitably. Awareness, strategy, and foresight will define who prospers and who is left behind.